Hey traders, welcome to this video. Will Sebastian here, pro multi-asset day trader. Don't forget, if you want to learn to trade, go underneath and you can come join us on a daily basis, join professionals and learn how things are done. I'm going to run over a few lessons, important lessons that you can cover via the pound CAD and some things to really note and really look at. And the reason why I would say, first of all, is because of the swing, how large it is, the volume, and the distance at which we have seen. If you really take it from the extreme low, okay, when you really had a fall here on some CAD strength pound weakness, you can see you've come up really from 1405 to 1815. Okay, a considerable thousands of pips move. If you look more simply on this dip here, 1635 to 1815, you can see something really, really clear. And what that is, you can see my chart is set to blue and red. Yours might be green and red, white and green, whatever it may be. But you can see there's a red candle there, and now here. Okay, so there's several red candles within this drift to the upside. If we look at our daily, okay, or perhaps our weekly first, it's very important to utilize all time frames to get a clear picture. You can see there's a very steep upside trend there, and mostly this just comes about off the back of CAD weakness. Okay, quicker easing cycle out the Bank of Canada has led to just these really, really quick moves higher and higher. So higher lows, higher highs, and a very obvious uptrend. Now, of course, if you were shorting this on the way up, you probably would accumulate drawdown. You'll take profits, on some of the falls when you do dip back like this, and you'll be in gains. But if you only shorted, okay, on these rallies, you might have bought along the way, but if you started to accumulate shorts, you might find over time that, those shorts are losing you money if you just keep whacking up. So if you reshort at the same level, for example, in this instance, 10th of June, and then again on the 8th of July, you would find that that short failed, and some of your shorts will fail. Now, whether you use a stop loss or not, there's a lot of things, including hedging, specifically for us, that can be done about this. And it works so well because, you can utilize the long side opportunities that you receive, which, of course, are not only on these dips, which I'm labeling, but they are also many times within those falls on lower time frames. Because if I put us down to the daily, you can actually see, instead of just buying once on each fall and getting it absolutely spot on, by the way, if you did, that's what you would have to do, you could rebuy all the way up. So you could utilize lower time frames, your daily, 4 hour, etc., mostly your 1 hour and 4 hour, to take advantage of multiple moves within one move. So something like this, where you swing up, something like that or something like that, actually involves many longs and lots of gains accumulation. And what that does is it allows you to get rid of any shorts that you miss or get wrong, and it generally just buffers up your your equity as such, or stops you sinking as quickly. And that's why we do it. We hedge to protect our capital, mostly, rather than using stop losses, because it's much more effective. It means instead of just trading one way and getting it wrong, because there's lots of people who aren't in our academy who would ask me on my post, well, when's this going to fall? When's this going to fall? I keep shorting the pound CAD. It's not coming down, and I'm not using a stop. I'm not using anything. I'm not protecting with hedging. When's it going to stop? And it's a problem. It really is a problem, because the truth is you don't really know when it's going to actually stop, definitively. I mean, in many cases, it's just going to go higher anyway at some point. But especially when you've got a quick easing cycle, via Canada, for example, then you would expect to go higher. So sitting and saying, oh, when's it going to fall? When's it going to fall? Is futile. Even if we've got a dovish pound, a dovish Bank of England now, it might not matter if you're still seeing, continuous, as you are, dovish rhetoric out the Bank of Canada and quicker easing cycles, in some cases quicker than the Federal Reserve. So if you hedge on all these falls, and you don't just hedge once, you hedge multiple times on lower time frames, what happens is you start to pick up gains. And this is what I've done. So I've been able to remove shorts I took down here, with gains made on the long side, so that when we finally get up here, I'm not sitting with massive drawdown on this position. This position that I may have taken there is no longer there, and I'm not accumulating that drawdown. Whereas someone who hasn't hedged and doesn't want to reduce this, they don't want to get rid of their short because they don't have the gains to do it, and they didn't use a stop either, will be sitting there in loss, worrying about this, which very well may occur. Okay, you may see an extension along this trend line and a pop to the upside. Again, not a million miles away whatsoever. So that's why hedging is so effective, because when you've got things like this, even if it's a much steeper uptrend, you've got so many opportunities to accumulate the gains and just remove any shorts you had. I mean, if you shorted over here and you took gains on a fall there, and then you short again, but the price goes higher and then higher and higher, and you never close, your short that you took here in line with this level, okay, is still going to be in play by the time you get up there if you don't hedge in between and take those gains. Now, it's all well and good saying, oh, hedging, that sounds brilliant. I've just watched this video on hedging by this guy from England, and now everything's great. I'm only going to hedge if we get near the 20 MA. It just doesn't work like that, because ultimately it's going to flop down and your hedges will need to be hedged out again. And it's a continuous cycle. That's why we call it a cycle, if you've ever watched any of our public showcase, because the markets are cyclical. They move in cycles, up, down, sideways, over long periods of time via the orders that are being dealt via traders in all kinds of scenarios. Okay, and this would be a hedge for a long-term investor. Someone who actually still is sitting on a short, perhaps lower, might decide, okay, well, I've got this short losing money, so I'm going to hedge for a potential move to the upside, and therefore gains accumulation. Okay, so very decent this morning. I would imagine many took hedge gains. You can see real weakness in this, so I wouldn't be surprised if it does flow lower. And then there's a hedge zone there, or a standard long zone for lots and lots of people. So that's how hedging works in the best format. Don't forget, if you want to learn to do that and make an income out of it like we do, go underneath. See you in the next one.